Hello, this is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. With this video, I'm going to look at J2-Global Inc. Together with its subsidiaries, they engage in the provision of internet services worldwide, and it operates in two segments, business cloud services and digital media. I love companies that have consistent and high levels of earnings growth. This orange line plots J2-Global's earnings growth going back since 2003. And I want you to notice it's been very steady. Even through the Great Recession, this company was able to grow its earnings. Earnings since 2003 have grown at 20.7%. The company also recently started paying a dividend in December of 2011. As you can see, the dividend has increased. This area below the white line here is the portion that they pay out of their earnings and dividends. You can see they still retain most of their earnings because the company's growing. Now, I also am attracted to stocks whose price tracks earnings, but I think investors need to come to grips with the reality that the market doesn't always price stocks correctly. Here's a case where you can see J2-Global's earnings and price correlated very highly with the normal volatility you see with short-term stock prices. Then the Great Recession came along, and all of a sudden the market started pricing this stock significantly below its earnings justified value, but that eventually corrected itself in 2013. But the real key is you can see that in the long run the company's stock price has tracked its earnings. Now, the market values stocks differently, and in this particular case the normal PE ratio for this stock over this time frame has been about 17. But watch what happens when I shorten the time frame. Since 2008, the market has been valuing a normal PE of around 14.5. But what I really want you to see here is the clear reflections of overvaluation and undervaluation. There's a period of time where the price was undervalued here, became slightly overvalued, came back to fair value, got overvalued and back to fair value, and currently now it's trading at a very attractive valuation. But the company also pays dividends, so your rate of return since 12/31/2007, the percentage of growth would have been almost 300%, and your total return is 16.5%. But some of that return comes from dividends. So you clearly see the stock price tracking earnings here, and then this light green shaded area represents the additional income that comes along, including the capital appreciation from the price moving from point A to point. So all this earnings growth and the dividend record, which has grown in the 30% range, all add up to performance that's significantly better than the overall market. Since December 31st, 2007, J2-Global would have turned $10,000 into just under $40,000 and paid $2,973 in dividends. That's $1,000 more in dividends than the S&P paid, and probably slightly over 2 times more profit than the average company earned. So this company generated 16.5% in contrast to the market that only generated a rate of return over this time frame of 6.5%. Now let's move on and take a look at the future. There are 6 analysts that forecast earnings growth of 19.6% for 2016, and then 7 analysts that are forecasting an additional 16.8% growth for fiscal year 2017, which ends in December, and then that same analyst forecasting 14%. So we're looking at average earnings growth averaging about 15.5% over the next year and a half or so. That would lead to double-digit rates of return if the company traded at a reasonable PE ratio of 15.6. If you look out longer term, there are 3 analysts that are forecasting this company will continue to grow at over 15% going forward. And another thing I really like here, when I look at the analyst scorecard, I discovered that the analysts have been extremely accurate when they were making forecasts 1 year in advance, and extremely accurate when they were making earnings estimates 2 years in advance. So the bottom line is this company has either met or beat analyst estimates almost virtually 100% of the time. So that gives me a lot of confidence that these analyst estimates might be at least within the ballpark of being accurate and reasonable. So we have a company here that has some really terrific potential going forward, and the valuation is sound. It's not necessarily cheap, but it's certainly attractive, and that's important because we have an overvalued market right now and it's hard to find value. The company yields 1.7%. It has 34% debt, a BB credit rating by Standard & Poor's, and an excellent record of growing their dividend year after year since they started paying one. So here's another example of a company that looks very attractive in today's overheated market. But as always, do your own due diligence and research. This has been Chuck Carnevale, the Chuck in the Markets Up Chuck, trying to bring another value opportunity to you. Hope you enjoyed it. Thanks for watching. See you soon.